Welcome everyone to another episode of Mere Finance. Today we're going to talk about a question that people have is when should you refinance your mortgage? When doesn't it make sense to refinance your mortgage? We understand that a lot of people bought at 6, 7, and 8%, or they finance their mortgage at 6, 7, 8%, their house. And rates apparently should have been down because the Federal Reserve, so the Central Bank of the United States, dropped their effective federal rate by 50 bips or 0.5%. So you will think, oh, rates are going down by 0.5%. Well, that's not the case. And we're going to see why is the case. And then when does it make sense based on different interest rate scenarios. So at the end of 2022, we did this video of mortgage-backed securities, imminent crash or investment opportunity, because we were talking about the rate environment at that time. And if we remember, we did some analysis on mortgages, on the mortgage rate, if we were able to predict it. It's really hard to predict the mortgage rate, but there's some models that tend to explain it. So we understand that the market says that the 10-year treasury rate, so when the government issues a 10-year bond, that rate minus the 30-year mortgage rate roughly what we call the spread. And that spread across history apparently is a good predictable of what will be the future mortgage rate. So if the 10-year goes down, the 30-year mortgage rate will go down and vice versa. At that time, the 10-year constant maturity rate was at 4.25 and the average spread for 2022 was at 2.47. So if we sum that, then we were expecting a 6.72 mortgage rate, 30-year mortgage rate. At that time, it was at 6.49. Currently, the average prior to that in the last 10 years was 1.73%. So as you can see, it's kind of hard to predict, but the average seems to be around 2%. 2 and depends on the time, 2.5, 2.3. So let's check what's happening now and how we can refinance our mortgage. So this is the current spread for the last 6 years. You can see the bottom is like 1.4 and all the way up it's around 3%, 3.1. So that's the difference between the 10-year and the 1 year, and the 10-year and the 30-year. So as you can see, 2022, actually we thought it was high, but it got higher now in 2024, although it's going down. So let's talk about our model. When does it make sense? Because the average currently is 2.15. So the average actually went down a little. So let's talk about when is the best time to refinance. So here's in the left, your current loan, right? So you will have your remaining balance. I don't know. This is just an example of 500. If you put a certain amount, this is how much you owe, 430,000. I will show, and I can share the model as well. It's in the comments. So you can play around and change those numbers. So my monthly payment, in this case, is $2,824.79. And the coupon, which is my current interest rate, is 6.88, which is kind of like what people did in 2024, like kind of the average of how people got their interest rate. Now, say the interest rate, the new loan will be to the right. So if you refinance at a 30-year, you can also change that. And the coupon will be the interest rate. That's the model we want to change. And then there is always, unfortunately, points. So usually some mortgage lenders, when you refinance, they will charge you 2% of the remaining balance, plus a cost and some fees. So in this case, we just said at 2%, and usually the cost and the fees $1,500. So your net payment, in this case, it didn't change, right? So what we're going to focus is on the break even. So when we change the interest rate, there's going to be a difference, right, between what we pay and what we are going to pay. So there's a saving component, but because we have to pay, in this case, $10,100, how many months will it take for me to break even? So for that difference that I'm saving to actually pay the total upfront cost. So in the model that we created, here is a rate improvement. So above, you can see if rates went down by 0.25, 0.5, 0.75, 1%, 1.25, 1.25, all the way to 3%. And you can see the break even in years. This means that if rates, for example, we focus on the 1%, so rate improvement of 1, it will take 2.78 years to recover that. So if you can see, even if it drops 0.5%, it will take you 5 years to break even. So it doesn't make too much sense when the average mortgage, or when the average person or household stays in a house for only around 7 years. And this is the graph that we want to show. And this is a better explanation visually of what's happening. So as you can see, 0.25 will take 8.7 years to break even, and then 50 bips, it will be around 5 years, and then 0.75, 3.59. So it starts making more sense when you see a rate improvement of 1% or more. You can see at 2%, it takes 1.48 years to recover that break even. Now, we can change the model, of course, right? Depending on your remaining balance and depending on your upfront costs, but I will share the model in the links in the comments below. But this is a visual representation of when does it make sense. And I think the consensus is when it starts to get at around 1% improvement. So if you have a mortgage rate of, say, 6%, you will want to see refinance rates at 5% to actually make sense for you to refinance. Else, you're just going to start paying upfront costs, which will take years and years to actually recover that. So instead of that money you can put in the market and, the total upfront cost and just invest it. So as you can see, I think the conclusion is from 1% rate improvement, that's when you would like to start refinancing now. So let us know what you think. Hopefully this is helpful and you can see the model. Thank you for watching.